All right, there wasn't a lot of news on the economic calendar today or the earnings front as we head into a new earnings season, but that doesn't stop the markets, right? There's a lot of news that typically comes out of Washington these days, and the market responded in both directions today. I'm going to break down how it did that and what that means to our expectations based on the market forecast and other technical indicators that we're setting up coming out of last week into this new week. So let's go ahead and get started. Today is Monday, April the 9th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those that are watching us for the first time. Glad you found us. Keep coming back day after day for more. Subscribe to my YouTube channel. You can see down here in the bottom left corner, or bottom right corner of your screen, there's the logo, Market Scholars logo. If you hover over that, you can click there and subscribe to the YouTube channel. Also, when you're on the YouTube channel itself, there's a thumbs up icon down below the video. Click on that. That lets me know two things. Number one, you like the video today. Number two, you want me to do it again tomorrow. It's a one-click, easy way to give me feedback on the video. Comment on anything that stands out to you by scrolling all the way down to the bottom of the page. You'll find the comment section down there. And then join our daily Market Outlook email list. You'll see a link to do that in the video description below. Follow me on Twitter for more content in addition to these videos day by day throughout the week. You'll see my handle up on the screen at DavidSettle42. Like and retweet tonight's Market Outlook tweet, always pinned to the top of my timeline. Join our Market Outlook community on Facebook. You see the address at the top of the screen there. There's also a link down in the video description that will take you there too. All right, as always, let's start off by taking a look at the S&P 500 with the market forecast indicator, and you can see, it ended up being an up day, not nearly as strongly bullish as we had before. We get up to 2650, hit some resistance there. That's that old low point. We've had some troubles there in the past. We had that one kind of abandoned baby, or whatever you want to call that, candlestick pattern. I don't even think that's called abandoned. I know there is an abandoned baby candlestick pattern, and I think the premise of it's kind of similar to that. You can almost call that an evening star candlestick pattern too, a reversal pattern. Usually have a bullish move, so we obviously did not have a bullish move coming into that pattern. Regardless, we hit resistance, and then the news came out, about Trump's lawyer's office being raided and by the FBI, and that brought everything down at the end of the day. And still finished with a positive, with a gain. And remember, long upper shadows are bearish. They're more bearish at the end of a bullish move than they are at the bottom of a bearish move. They're still bearish, but not nearly as bearish here. So this actually can be considered an inverted hammer. Hammer would be the long lower shadow, right? So it's similar to this, but to the downside. So this would be an inverted hammer. So the psychology is the bulls were there. We had a good bullish day today. They ran out of gas, and the bears came in, but the bears weren't able to get it to new lows or anything. They just kind of wiped out those gains, but the bulls were there for a time being. And so that's a bullish pattern. You can see again, not as bullish as if it was a hammer, a long lower shadow, but a bullish pattern nonetheless. The intermediate line turns slightly higher is bullish again. Keep in mind, very weak posture. So as weak as we were over here, we're just as weak now, because we can turn right back down and have a bearish posture again, a strong bearish posture. So we're not very strong. The near-term line has popped down into the lower reversal zone. It's setting up for the possibility of a bullish low point. You can see that here's the last bullish low that we had in green. The red line being, or the orange circle being the intermediate low point we have here. So theoretically, now this would be it would be a slightly higher near-term low point than the last one that we had. So we'll see if that ends up playing out. Would be, again, like I said, a bullish low point there. Momentum line turned up a little bit, not nearly as higher as it was earlier when we were at the highs of the day. So some volatile day today. Market sentiment's falling. Path of least, which means, again, path of least resistance to the downside. So it's not going to be easy to get going. Doesn't mean that we can't. It just takes a while to get that going higher. Once that gets going higher, then most days will be up days like back here. Until then, most days are going to be down days, and it's going to. We have to reverse a lot of this selling pressure that we've had. It doesn't get reversed overnight at all when market sentiment is this low. It can up here when market sentiment's higher, but when market sentiment is falling and this low, it's not going to be easy to turn it around. But it can be, obviously. So that's what the S&P. So bullish posture, possibilities of a new bullish near-term low, but weak posture. So we're not bearish anymore. The posture's not bearish anymore, but we're not really out of the woods yet either. So keep that in mind. The Dow Jones Industrial Average, and we were looking for a bounce. We were looking for this bearishness to end on Friday's video, and you can see it. So far we've done that. Same pattern showing on the Dow Jones Industrial Average, the exact same pattern pretty much. The Nasdaq pulling back out of the reversal zone, showing a bullish pattern too, very similar pattern. Falling market sentiment, everything else the same here on the short-term and intermediate posture. Same inverted hammer / Harami pattern forming on the Nasdaq, and then finally the Russell 2000 here had a kind of a tombstone doji or dragonfly doji, whatever kind of doji that is, but similar to an inverted hammer, long upper shadow. Again, you can see same intermediate and short-term patterns, and again, falling market sentiment will still put pressure on it, and you can see this one's got another trend line that we still have to break up above before things can really turn around and get bullish again. Just a reminder, if you're watching this video embedded in the YouTube, that you can, in our blog, you can use these icons here on the bottom of your YouTube player to change the resolution and the speed to see it full screen. You can also like and retweet the Market Outlook, tonight's Market Outlook tweet. It's always going to be right there, so you can do that while you're watching. If you have a Facebook account, you can like the Facebook post there too. Off the Facebook page. Of course, there's a like button here on the blog. You can join our daily Market Outlook list here. All this you can do while you're watching. Remember, too, that we have a promotion going on for gift cards for the most engaged market scholars in the forums here. There's a post on that in our blog, too. There's a link for you, Market Outlook viewers, to go to the forums and open any new topics or reply to any existing topics right above the video there. You can see here how we were smidgen below that 200-day moving average last week, closing on Friday, and then getting back up above it today. Couldn't quite get above that 50, so that 50-day moving average is also going to act as a little bit of a resistance as it's falling here. But don't be surprised, again, like I mentioned on Friday, that we don't get a green arrow this week if we don't eventually get up above that. And, of course, getting above these two highs here will be bullish for the index and holding this and making another run. See, just because we're at the 200-day moving average doesn't mean, with some volatility, doesn't mean that we can't run off of this, right? That's generally what happens when we get in these situations. And yes, MACD is way, way down and falling, but it usually doesn't drop so quick to zero without some ups and downs along the way. So based on that pattern and precedent, I am anticipating another swing higher on this MACD, which would obviously coincide with a jump, which would mean that the blue line's got to turn back up, and it won't turn back up without the index getting up above it here sometime soon. Of course, news can throw all the technical analysis out the window, right? But right now, this is the price environment that we're setting up for as we go forward. You can see that we have arrows showing up, the MACD and the stochastics. They're both green arrows down here. Both those lines are above their moving averages as they're starting to slowly turn higher. The moving averages themselves are turning higher. You can see we did, on an intraday basis, get back above the 17-day moving average before coming back down below the 8. So you really kind of got to break those moves here. And usually, like I said before, when you get a divergence to the upside, you'll typically converge. Now this was faster, but that's not normal. You typically will converge back to the moving averages, and then when you diverge to the downside, you typically come up pretty quickly. And that's the normal trend, and that's, it doesn't have to happen that way as you saw here, but that's what you'd expect based on what happens more generally speaking. So if we were to get back up above, again, those 2 week high points are in this area. Right about, let's see, yeah, right in this area here are those high points. We get above those high points, 26.75. the high point for this week, the high point for this week. Get up above 26.75. That will get you above the 17-day moving average, and now start testing that 30-day and get the 8-day to start making its way higher. And like I said before, you usually don't converge slowly to the moving average coming up off of lows. We usually will diverge really quickly back in the other direction. So as you look at today's intraday move, you can see the intraday data isn't here on the profit charts, but you can see how we finished right there yesterday. We gapped up to the upside and had a good rally off of that, so kind of fulfilling that pattern that we've seen before here and back over here, how we rallied up, and you can see we even rallied up to 264, 265. If we end up doing something like this here, so we have this, this pattern, we come down, form this one, and we could get another move down, kind of a double bottom to 259, similar to the left shoulder. That was kind of a double bottom there, then the head, and then can we get another, the right shoulder forming similar to what we saw over here. So that remains to be seen. Of course, the rally today on the fears that this trade war might not be as big of a deal as has been talked about, but then more issues with the administration, the current administration, legal issues at least, and the market doesn't seem to like that. At least, the precedent has been for any seemingly negative legal news concerning the administration, the market has initially sold that off, only to recover it rather quickly. Essentially, this is a temporary sell-off that we've seen so far, right? The trade issues have been kind of more of an issue for the market, but even then, those sell-offs have been temporary as we've been unable to break through these support levels from the last little bit. If we take a look at today's range, was a decent size range. It was almost 5 points, but look at the volume there. Even with the selling at the end, the volume was really, really light. So 5-point range is at the high end of the 52-week average. You remember, that's a pretty high level. That's a pretty high ATR for an average compared to where we are, and we typically peak around there from an ATR standpoint. And then the volume again was below average and kind of in the lower half of the chart here. So it really wasn't the most bearish volume. And when you look at the volatility index, we bounced up today on that close at the end, but still we're only at 20 below 22. And on an absolute basis here, on a relative basis, we're at 1.03. So we're in the bearish zone, but we're not in the extreme bearish zone when you get up to above 105. So yeah, we have a weak bullish posture, and we don't have anything necessarily that says we should be more bullish than that. But we also don't have anything necessarily that says we should be pretty bearish, that we should anticipate that this really strong support levels here is going to break. We don't have any technical confirmation of that yet, but we also don't have technical confirmation either that we're ready to be more bullish than what the market forecasts suggests that we be right now with its very, very low position. When we take a look at what's driving the action, you can see there wasn't a whole lot on the actual economic calendar. There was a lot more to it than that, and it seems to revolve around Washington here. You can see that the rolling, even though there was nothing on the calendar today, this is the economic surprise index is a rolling 3-month window. So things are falling off on the other end too, and that's bringing the economic surprise index down lower. You can see, and you can also see from a global perspective, it's really getting down. In fact, it's getting down now to some of the worst levels we've seen in the last so many years at -21. And of course, U.S. is not involved because the U.S. is still at some of its highest levels. Aside from late 2017, this spike up that we had here, we're at relatively high levels in the mid-30s than we've seen over those same past many years. So, again, everything's relative in investing, and you put your money somewhere. Even if you put it in cash is a currency, so everything's relative. So where you put your money, and U.S. continues from a relative standpoint continues to be, the better alternative from an economic growth and corporate earnings standpoint relative to its peers, at least in the more developed nations. You can see, compared to EFA, SPY, the S&P 500 started the year pretty strongly. It has pulled back in the last so many weeks, but still, you can see there's, kind of a double top forming on this relative strength chart, but still kind of trending higher. When you compare SPY to EEM, it's been coming down all year, 2017, for most of this year, and a lot of that has to do with the dollar. Going back to the previous ratio, again, it's where do you put your money? Everything's relative, and so from an economic standpoint, it still shows the economic growth story is still in the U.S. compared to other places. When you take a look at how the major assets performed today, of course, there's a roller coaster ride. The S&P 500 led the way higher along with crude oil. You can see crude oil went down, or crude oil was flat. While the stocks went down, crude oil was flat. High yield bonds, flat. Gold, flat. Bonds went up a little bit, dollar flat. So, this was really, from this point here, it was a U.S. stock sell-off and international stocks came down with it. Everything else didn't really move at all aside from bonds. So it was just a reactive move to this FBI raid of the lawyer. And like I said before, until something changes, the precedent on any kind of negative news concerning the administration, again, from an apolitical standpoint, is that the market sells it off initially, and then bounces, and that sell-off ends up being temporary, and the market typically bounces back up. And until that changes for whatever reason, then we follow the past precedent. When you take a look at the sectors, you can see technology, healthcare led the bounce early today, and you had your safe haven areas lagging behind, along with energy and materials. Remember, the dollar was flat. By the end of the day, from the peak in the dollar, or the peak in the S&P down, it was broadly led by technology and financials. Your two biggest momentum players here lately. And then you can see energy and materials lagging because the dollar was flat. They didn't really impact these. And then your safe haven areas holding their value better. So by the end of the day, from close to close, through the roller coaster ride here, you can see your safe haven areas ended up pretty flat on the day. Industrials, discretionary, real estate and staples, all negative. Utilities with a small positive along with financials. And you can see technology, even with this steep decline, finished 0.8% higher, and healthcare finished up 1% higher. So pretty decent moves to the upside for those two particular sectors. As I was looking at charts today, one chart that stood out to me is that energy sector, because you remember the stocks didn't go up as much as crude oil went up. And if you look at the chart for XLE by itself here, you can see it's been pretty volatile from a volume standpoint and the size of its candles, but it hasn't gone anywhere. And you notice, using the volume profile here, it's pretty much sitting right at that point where most of the volume is traded over the past year. And this kind of gray area shows you where most of that volume has been. We're kind of stuck in this range where there's a lot of interest from the buy side and the sell side. And so we can trade, we can sell outside of these bands. Oh, another thing too that stood out to me is it has relatively high volatility right now. The options are relatively high volatility, but the stock is higher. So the stock, the options are expecting the stock to get less volatile than it is right now. And of course, we know as volatility jumps, it typically falls back. If we were to take a look at the volatility chart and add that in here, implied volatility would be right there. You can see it typically falls from high levels. So if it starts to fall down and historical volatility comes down with it, then things will just, even if it does grind one way or the other, it will just grind and get less and less volatile than it's been right now. So we can sell outside of that and look at, for example, if you were to look at the May options, now this will be a little different because of how volatile it's been and expected to get less and less volatile. We can take advantage and sell these 30 deltas, mid to low 30 deltas on both sides. In this case, selling the 66, selling the 70. And what that looks like is right here. And if you can see, my break-even spots are right about 64 and 72. Let me show you what that looks like here on the actual chart itself. There's where your break-evens are, and you notice how far outside this current range we are, and you can see the support to the downside, and of course, you know, it's about the midpoint of this decline, the 50% Fibonacci retracement of that decline. In fact, let me throw that on there, and you can see that a little bit better. It would be this one here. So the decline here in energy stocks, you know, there's your 50% level is right about where the break-even would be. So there'd be some Fibonacci resistance in this area. And then you say, okay, well, when would I get to the point where I would lose as much as I'm trying to make? So I'm trying to make $219 here on this short strangle. And again, I'm taking advantage of this strangle because the Iron Condor doesn't offer as much premium. So this strangle, you notice, for me to get a $219 loss to the upside, the stock would have to go all the way up there. To get a $219 loss to the downside, it has to come over here, right there. And if I throw those slices on the charts, so now we have to go through all that Fibonacci resistance to get to a $219 loss to the upside. And then it'd have to break through those lows to the downside where all this volume is kept in this area. So, and again, that is just to have a 1-to-1 profit to loss ratio. And also remember too that the market expects the stock to get less volatile, not more volatile. Of course, anything can happen, but based on current expectations, it's expected to get less volatile, not more. So that being said, there's an opportunity to sell those options on a stock that's gone nowhere on the basis that, you know, as much as crude oil moved today, the energy stocks didn't really move along with it. And you can see by the end of the day, stayed right at its point of control, where the most volume is traded at this price level over the past year. As always, thank you very much for watching. I do appreciate the time that you spend watching these videos. Hopefully you get something out of it here, including not just the posture of where we expect the market to go, but also a way to take advantage and trade the market on a day-to-day basis. Remember to subscribe, like, and comment on the YouTube channel down below. Also follow me on Twitter for more content like this, and join our Market Outlook community on Facebook. Have a great evening, everybody. We'll see you all tomorrow.